Thanks for tuning into Worldview. I'm your host, Neeraj Shah. Lots happening on the world landscape, which has a material bearing on how risk assets, by and large, do over the short, medium, and the long term. And Professor Russell Napier, he's the author of the Solid Ground Investment Report for Institutional Investors. That's the formal introduction, but he needs no introduction, really. Joins us right now to uh, for me to quiz him on some of the aspects and try and get a bearing of what it would mean for the investing community at large. Professor Napier, good having you. Thanks for taking the time out. Hope all is well.
Thank you. All's good.
Great. Before I actually get down to some of the thoughts that you've expressed in the recent past, I would love to understand from you if you have some thoughts around whether the before and after of the much spoken about debt deal has any big implications for risk assets, what the Fed does to QT or QE, as the case may be, and even inflation.
It is interesting that the Democrats and Republicans seem to be coming to an agreement, and the debt level is too high. There are only 5 ways you can bring a debt down, excessive debt levels down. And it looked for a minute that the Republicans were prepared to try one or two. One or two would be default, seems highly unlikely, but number 2 would be austerity, and that's not going to happen. So that means, what is the plan to bring it down? And whatever the words used by the Republicans, the government and the opposition are both aligned in this will have to be inflated away. You won't hear Republicans saying that, of course, but that is what this agreement means. It's much more obvious in other jurisdictions than it is in the United States. But the 5 ways to bring it down are default, austerity, hyperinflation, very high real growth, or financial repression. And we've backed away from the first 2. So making it even more clear that the socially acceptable is financial repression. So inflation to stay higher for longer. And then the question is, does the central bank really get aggressive at tackling that? Or does the government counteract the central bank? And that's what this is really all about now. It's the struggle between the central bank and the government. And the government ultimately needs that bit higher inflation, maybe not 10%, maybe not 8%, but certainly more than 2%. If these debt numbers are going to work.
And you have some thoughts on using inflation to eat away the real value of debt being the only option. But just before I get there, do you reckon that this whole conversation about when would QT and then QE begin, if it will, is now a sealed fate because of the debt deal being reached? There are thoughts expressed that very soon we'll see the Fed end QT, and much like what happened in 2019, begin some bit of easing as well. What are your thoughts there?
That's certainly possible, but for a different reason to do with debt. The thing that drives QE is a contraction in the supply of broad money. This goes back to a famous speech that Ben Bernanke made at Milton Friedman's 90th birthday, where he said, "It was our fault, Milton. We let it happen, and we'll never let it happen again." And he referred to Milton Friedman's famous passage, which attributes the Great Depression to the willingness of the Federal Reserve to allow broad money to contract, the total amount of money in the system to contract. But most people watching this will know that that is exactly what's happening to American broad money at the minute. And when Bernanke was faced with that problem, he did QE. And in 2020, when faced with the same problem, we created carrots and sticks that made the commercial banking system lend money and create money. So if this continues, and it is now got into commercial bank balance sheets as well. So commercial banks are, for the last 4 or 5 weeks now, destroying money in America. Then something has to happen. And what has to happen is QE in the first instance, but ultimately something to force banks to expand balance sheets and create money. So unless they've forgotten the lesson from Milton Friedman's 90th birthday party, I think we should expect something to come soon to prevent this contraction in broad money from continuing.
Okay. Now, I move on to the other aspect on which you have spoken and written about as well, which is that with the global debt to GDP ratios at the levels that it is, a bunch of countries or central banks, as the case may be, will use inflation as to eat away at this debt problem. Now, my question though is that if indeed that remains to be the case, and if indeed inflation stays high, and therefore if interest rates are high, can it be a problem for risk assets?
So it's already working, and this is worth pointing out. If you look at the debt to GDP ratio for the developed world, it's already coming down quite quickly. Two reasons. One, nominal GDP growth has been very high, but two, the market price of debt has been coming down as well. So they see some success here. This takes us back to the battle I mentioned earlier. If short-term rates are controlled by the central bank, will it keep them high to control inflation, or will the activities of the government swamp that action? I'm in the second camp. I think we've seen very proactive US and Swiss governments, particularly this year. And therefore, we are constantly say that there has to be a relationship between the price of money and inflation. And in a market system, that is true. But in the system we're increasingly slowly and sometimes quickly morphing into, it doesn't have to be true. So for risk assets, if the nominal rate is peaked or is near peaking, and inflation is coming down slowly but very slowly, that I think is good for risk assets. Maybe we should look at it the other way around. This is a scenario which is so bad for bonds that equities will do reasonably well. Now, I can talk at great length about which equities, but it has to be equities that are not particularly highly valued. And the S&P 500, as you will know, is particularly highly valued, but there are shares trading all around the world on low valuations. And in a scenario where inflation stays high, but interest rates don't go up, and the government keeps adding stimulus elsewhere, either fiscal or through the commercial bank's balance sheet, I think that's a good outlook for selected equities, but if not for the big index in the world, which is the S&P 500.
Yeah, it's interesting you mentioned this, wherein it's only at the start of 2023 that people started saying that we are finally moving from an era of TINA, which is there is no alternative to equities, to there are reasonable alternative to equities. It's seemingly been very short-lived, in which case.
Yeah, because nominal rates will be attractive. I mean, higher nominal rates are attractive in terms of anybody seeking an income. But that's because we're still living in a world where we think those nominal rates reflect or perhaps ultimately protect us from inflation. I mean, if you look at inflation expectations, they are in many cases now below nominal interest rates. So I could commit my capital expecting to get a return, which maybe over the long term would be something in real terms. However, we have to then begin to realize that inflation is much stickier than we think. And that's because the governments require it. That's what we're discussing here, isn't it? The need to have higher inflation as a policy tool, not 10%, but certainly higher than 2%. So that is dawning very slowly. And as it dawns a bit more quickly, then people realize that this interest rate does not compensate you for that. But corporate earnings can. I don't say will or do, but can in the hands of the right management, in the right industries, at the right time. Corporate managements can defend you from that combination of where inflation is above the rate of interest. So the market's still working on the basis that we live in the old system. But I feel very strongly that we've moved into a new system, and that nominal rate of interest does not compensate you for the risk of inflation. I am talking here about the developed world, not the emerging. I think the emerging world looks somewhat different.
Yeah, I mean, any thought, actually, any difference that you would bring there, which is stark for you, part one? Because I have a part two on EMs as well, which is with regards to flows. But since you brought this up, you're talking about the emerging world looking different. I believe it's looking materially different in certain cases than the developed world.
Yeah, I think the word emerging is a very interesting word. It's a word attributed and measured now by GDP per capita. That the people who construct the equity indices, that's how they measure it. But for a saver, and that's what we are, if we're investing in the markets, we have to think of it as, I think, protection of property rights. And one of the reasons that emerging markets have always been emerging, if you like, is because their protection of property rights was less than the developed world. Now, that's changing fundamentally. I think in India, a long-term trend now, but protection of private sector property rights is going up, if slowly and not always in a straight line. But the point is, in the developed world, they're coming down quite quickly. There is lots of contention over what the government of Switzerland has done to private sector property rights. A few speeches in the last week or two from the United Kingdom government talking about how they might force pension funds to own assets that the government dictates that they should own. Once again, intervention in private sector property rights. So when we use the word emerging, we need to start with the basics. And I think the gap is closing between developed world and emerging worlds. I'm not saying that the emerging world is moving rapidly to enhance private sector property rights, but they're going the wrong way in the developed world. And that should enhance capital flows from one to the other. Now, there are many other reasons driving those capital flows as well. But the word emerging, I think by the time this is over, which could be a decade or more, I think we'll reconsider what the word emerging actually means and think about it more specifically rather than the GDP per capita, because I think as I say for now, it means less and less.
Yeah, well, yeah, point well taken. But by the way, since also we're talking about flows, I mean, this point is a very interesting conversation. Maybe not a decade out, maybe even earlier, and we'll probe more about that when we get you next. But today, here and now, I want to talk about the other aspect of flows, which is again correlating it to the earlier part that you mentioned, which is your theory, I presume, that economies will have to inflate their way out of the debt issue. If that results, could that result in significant flows out of DMs or from DMs into EMs, Asia Pacific, what have you, however you want to define them?
Well, the answer should be yes. Remember what's going on here. The first rule of a financial repression is to get your money out of the country. That's the first rule, because people just think of it as inflation being higher than interest rates, but there's much more to it than that. And it involves the government playing a great role indeed of steering where capital should be going to. And it's a direct attack on savers. It's an attempt to move money from savers to debtors.
Yeah.
Now, if you could find a country that wasn't doing that, you'd want to put your money there. Now, many emerging markets, including India, will not have to do that. India's debt to GDP ratio is low. Its private sector debt service ratio is low. There are many other emerging markets in the same situation. So you should expect a structural flow of capital associated with the developed world implementing those policies. Secondly, and this is a different story, but it points in the same direction, we have a deteriorating relationship with China. And I think most people watching will obviously be familiar with the sort of growing evidence of a Cold War. That should also attract more capital to where there is cheaper labor. So India and the emerging markets in general can benefit from both forms of capital flow coming. And I think one of the problems might actually be too much capital.
Well, it's something that maybe we haven't seen for a long time. Maybe we saw it in between 2003 to 2008. Since then, at least India hasn't faced that good problem, if you will. I mean, I'm calling it good, though it could have its own implications as well. But a point that you've made in one of the articles or one of the pieces that you've written is that we will see a boom in capital investment and a reindustrialization of the Western economies. Now, we're talking about financial repression, presumably in the Western economies, because that's where the larger part of the developed markets are, and capital flows flowing naturally into the emerging or the Eastern economies. And at the same point of time, we're talking about large industrialization in the Western economies. How would the two happen simultaneously? Part one. And even if they do,
Sure.
What is the impact of this onto demand of labor, equipment, and flow of goods and services from one vertical to the other?
Yeah. Now, obviously, a lot of this depends on our relationship with China. And it is much easier to see a simultaneous boom in industrialization in the developed world and emerging markets ex-China if you believe we're moving into a world where we trade less and less with China. So that's my opinion. I think that's where we're heading. I think our relationship with China will in due course be not dissimilar to our relationship with Russia. And I hope that is in the form of a Cold War and not a hot war. And I really hope that I'm wrong about that. But if I'm right about that, the scale of investment is big enough for everybody. There's plenty of room to go around for more investment in intangible productive assets in India, the rest of the emerging markets, and the developed world. The developed world is starting from a very small base. A lot of automation is necessary to pull this off in the developed world, but fortunately we have the machinery and equipment to do that. Most of it made in Japan, which is worth noting. And in India, it can be more labor intensive because labor is that bit cheaper. But even in India, we'll see more automation going forward. So yeah, both can run simultaneously. And now it's not just China. There are other trends going on here. The other trend is obviously climate change and how to fix that climate change. And that involves capital expenditure as well. There's a more general thing which overlaps with China, which is shortening supply lines and making them more robust, something we learned during COVID. And I think there are other political goals as well. I mean, we have a hot war in Europe, and that means another form of capital investment, the worst form of capital investment, which is armaments, something else which is going on. There are issues which we see as emergencies, such as the cost of living. Christine Lagarde, by the way, just a few weeks ago, talking about how the central bank should be facilitating supply side adjustment, in other words, funding extra supply, a radical suggestion from a central banker. So it is really about China, but there are actually 4 or 5 things all pointing in the direction that we need a lot more investment if we're going to pull off the political goals. The word emergency is used a lot now: climate emergency, cost of living emergency. And that's the problem. When you categorize political problems as an emergency, you ultimately turn to an emergency finance to fix that problem. And I see more evidence of it every day in the developed world, that we are contemplating the emergency finance to pull off this huge investment, which is not necessary.
Interesting. Professor Napier, I also see that while there is this need for serious need for making sure that climate change is tackled, and there is a lot of focus into sustainable and ESG, there is also a strong pushback against ESG in multiple forms, predominantly energy, but in multiple forms as well. So, what do you make of the deviation from what is actually a long-term trend established since some years?
So the ESG was a private sector approach, influenced, encouraged by government, but ultimately a private sector approach, and there was obviously 3 bits of it. What we're talking about now is greater government activism. So as a chairman of a board or a board of directors, there would be less choice in making these decisions. And I think that's where we're getting to. And actually it's already here, because we see quite a lot of subsidized credit now flowing through the European banks in particular to fund this. We've got the huge Inflation Reduction Act of America, which is actually sending a lot of capital to certain types of corporations to get them investing in this. So the ESG, if you like, will ultimately, maybe the private sector can get that to work, but if it doesn't, it's going to be made to work for them by the state. The state needs this money. It needs it invested. It needs it invested in certain areas, and it will get it there, whether private sector corporations wish to apply ESG or not. So if it's not coming from the private sector, it's coming from the state anyway. Importantly, not all sticks, sometimes carrots. And if you're a shareholder, you can actually benefit from some of this, because it comes in the form of cheap debt capital to fund some of this investment. You could be a beneficiary of that. So that's where it's going to happen anyway.
Got it. Final couple of questions. One is actually 2-part question. This whole chatter of de-dollarization, and I agree that the base is too large for us, for the world to move away in a massive, in a meaningful fashion. But we've seen some starts of it. And there is also this talk of what happens to, say, high import countries like India, again, for example, if it is able to, say, strike out a deal on a rupee-ruble trade for crude and then reenact that with maybe OPEC, and what it does to the current account, quote-unquote, issues that a country like India has had, because then the issues cease to be issues in the first place.
Well, the dollar issue is a huge issue.
It is.
Requires a whole program. But I think people have to focus on not who will transact in renminbi or even ruble, but who will hold them. So we have obviously lots of publicity these days, particularly about Saudi Arabia's willingness to accept renminbi in payment for its oil. Does it hold them? Well, we've got 2 ways of checking that. One, we can look at the composition of foreign exchange reserves, which we get quarterly from the IMF. There's no evidence that central bankers as reserve currency are deciding to own more renminbi. So they may transact in it, and China likes that transaction because it keeps the transaction away from the US payment system. But ultimately, it doesn't yet appear that Saudi wishes to hold those. Secondly, we have to look at private sector willingness to own RMB assets, and we get this through the net international investment position of China. Once again, it would seem that the private sector is more reluctant to own RMB going forward. So that's looking more at the China side than the Russian side. But I think ultimately everybody has to decide which side they're on. Now, those are not my words. Those are the words of Christine Lagarde, who in that infamous speech of just a few weeks ago talked about a 2-block world. And in a 2-block world, it wouldn't be possible to hold reserves in rupee, or sorry, in renminbi or in ruble. Now, it's another program as to which side of the line India falls upon here, but I think it's pretty clear which side it will fall upon given its position in the Quad, etc., etc. And therefore, this is somewhat of a benefit for India. But ultimately, it's going to have to sell these currencies as well. It's not going to be able to hold them. It doesn't show a willingness to hold them. And I think quite rightly, it doesn't show a willingness to beef up the RMB position in its reserves. So if there is a positive for India and able to transact in that, it's not a huge positive unless they can persuade people to own their own the rupee. If they can persuade people to own lots of rupee, then yes. But I think ultimately, if it's people America doesn't like, then it's not going to be acceptable.
Okay. But for the current period, Professor Napier, if there is a school of thought which is saying that if India is anyways transacting with Russia for crude purchases, and if it can do it via the rupee, and Russia would be only too happy. The school of thought, of course, I'm not saying it's right or wrong, but a school of thought that Russia would only be too happy to do that and plow the money back into either Indian infrastructure or Indian bond markets, which are materially different than what the Chinese markets are, any which ways. Then and then impress upon that same kind of trade with OPEC as well, then it could serve India's needs very well. You think it's a far cry?
I do. I mean, I know there was a non-aligned movement the last time we had a Cold War. It wasn't a very successful non-aligned movement. I don't think India can straddle. I think India's playing its cards very well. It's leveraging up all the advantages it has, but ultimately the idea that Russian money will be funding Indian infrastructure is not going to happen. And that's geopolitics, nothing to do with money, nothing to do with flows. It's also worth saying that at this stage, in aggregate, Mr. Putin's reserves seem to be falling rather than rising. And that's because he may be making money out of selling oil, but his import bill is quite high. Russia has a lot of reserves, but a lot of those are stuck somewhere else. So if you think that the scale of Russian investment in India can transform India, I think that's simply wrong. It's simply not big enough. I think it's geopolitically very difficult. But that doesn't really matter, because what is happening, in my opinion, as we discussed earlier, is there are other private sector capital flows, not the public sector inflows of a despot, but the private sector inflows of people around the world who see India as a good place to invest, whether FDI or portfolio investment. That dwarfs the sums of money that Mr. Putin can invest in India.
Yeah, sorry, I was not making the point of one versus the other, to be very honest. But thank you for putting that into perspective, and that's when I would want to. I mean, my final part of my of this interview will be on. Do you reckon the playbook for India would be different given its stance, favorable position, I might say, on the geopolitical landscape, and the fact that the RBI is doing its bit to make the currency look fairly stable as well. There are both portfolio investors and companies talking about making large-scale investments in India, and certainly doing it. Even though the actual FDI numbers, Professor Napier, the last 3 years have shown a decline, we've seen fair degree of headline-grabbing investment announcements made by large corporations. So what do you think of all of this, and how could it impact the India playbook over the course of the next, say, 3 to 5 years, if you have a thought on that?
Yeah, there are definitely things that make India different post-COVID. And one of them is this geopolitics, and it's quite right that India should try and get as much leverage over both sides. My opinion is that in the long run you have to choose one, but in the intervening period you can play off one against the other. But the post-COVID world, India is really going to stand out because of the Reserve Bank of India, and I think in due course we will be writing books about how well the RBI handled the COVID crisis, much better than the Federal Reserve, the Bank of England, the European Central Bank, even I would argue the Central Bank of Switzerland, the Swiss National Bank, because it kept a fairly stable growth in broad money. Inflation is showing the benefits of that. Long-term interest rates will show the benefit of that. We mentioned at the beginning the problem of too much capital coming in. Well, Brazil had that problem after the GFC because its nominal interest rates seemed very attractive and too much money was coming in. Never mind to fund real capital investment, but actually just to buy the bond market. And I think, if anything, as we look back now on COVID and the post-COVID world, one of the things that will really jump off the page to portfolio investors about India is Reserve Bank of India. I'm not going to call it a doyen of hard money, far from it. But compared to its developed world neighbors, it's done a spectacularly good job. I think it gets rewarded with that, with capital inflows. So we mustn't forget that central banking is probably alive and well in India, but suffering elsewhere. And if we go to a full repression, I'm not suggesting the Indian central bank remains entirely independent, but it's going to look very independent compared to some of the other central bankers in the world.
Well, Shaktikanta Das, our Reserve Bank governor, would be beaming when he hears this. But lovely getting all of those thoughts from you, Professor Napier. Thank you so much for taking the time out and speaking with us today.
Great. Thank you very much.
A pleasure was ours. And viewers, thanks for tuning in to this episode of Worldview.